Hey guys, welcome. Thanks for being here. Let me ask you a question. Do you want to trade options like the pros do? If you do, it's not just about calls and puts, it's about how the calls and puts work. And the way to understand how calls and puts work is by understanding the Greeks. The Greeks are the key to managing risk, being able to time your trades to the right expiration, and spotting opportunities from high volatility, low volatility, etc. It's what gives you an edge in your trading, and that's why all the pros use the Greeks. So stick around. By the end of this video, you're going to know how to use the Greeks. We're going to talk about delta, gamma, theta, vega, and how to apply that to your trading strategies. So first of all, what are the Greeks? The Greeks are ways to manage dynamic sets of risk. We talked about delta, gamma, theta, vega. When you trade options, you're not just betting on direction. Even if you are, you still need to understand the dynamics within the options of what makes the options priced a certain way. And that's where the Greeks come in. The Greeks are just risk indicators. Think of it if you are an airline pilot or you're piloting a plane. The gauges that tell you your speed and altitude and all that kind of stuff, that's what the Greeks are, and that's what they do. And what they will show you is the options, how the options price will change in response to factors like price movement, volatility movement, time movement, until expiration, things like that. And I always say when I'm teaching classes that think of it as a Rubik's Cube. You have price on one side, price movement on one side, you have volatility movement on one side, you have time to expiration on the other side, and they're all moving independently of each other. So how are you going to, how in the world are you going to track all that stuff? And the way to do that, the way professionals do that, is by monitoring and understanding the Greeks. So I mentioned before, the four main Greeks we're going to cover today are delta, gamma, theta, and vega. So let's jump in and we'll start with delta. So I've got a chart up here of NVIDIA, just randomly picked NVIDIA. Everybody likes to trade NVIDIA and everybody knows the stock. So let's jump over to our trade tab and we'll look at delta and how it applies to a stock like NVIDIA. And again, this would apply to any other stock as well. But here's the trade tab. This is NVIDIA. Here's delta. Now here's gamma, theta, vega. We're going to focus on delta for now. It doesn't really matter how far you go out in time. I'm just going out when I'm recording this video. I'm looking at the 18 July expiration. But the technical definition of delta is that delta measures how much an option's price moves per dollar movement in the stock. So how much NVIDIA goes up can be determined by this delta or vice versa. So what that means is now it's not exactly right here, but if you had a delta of 50, say 0.50, right? So it would be somewhere right there, right? So if you had a delta of 50 and NVIDIA goes up $1, that option would go up by 50 cents, right? If it had a delta of 50, you're going to get 50% of the movement of $1, if that makes sense, right? I'm trying to keep it pretty simple here, but that's the way it works. Again, it's a rough estimate here, but that's how it works. So this would be deeper in the money and this would be deeper out of the money. And an interesting thing, this tells you price movement, but another way that we can use this is tell you the delta can tell you the probability of the money expiring or the option expiring in the money or out of the money. For example, let me show you this. If we go down here to I'm just picking this, just say 23, so it's a 23 delta option. So what that means is that's 34 days left to expiration on this particular option, which is a 155 call option, right, on NVIDIA. So that 0.23, that means that there is a 23% chance that the price will be higher than 155. 23% is not not great, right? So if you're trying to choose where you're going to target, this just tells you what your chances are. If you said, I'm going to come up here to 185 and I'm going to buy some call options, there's a 2% chance that it will get there. There's a 98% chance it won't. So maybe that might be throwing money away. Maybe you know something that nobody else knows, that NVIDIA is going to do something great and it's going to rocket up here, right? That's the beauty of the options, is you can really fine-tune this to your particular strategy, your particular theory or thought process on the trade itself. So again, the delta is all about, think of D for directional. The traders use delta to gauge their directional exposure, how much direction you want to have, whether it's very deep in the money here or very far out of the money here, and it will really help you in managing your trades. So we're going to look at some examples here in a minute, but let's jump to our next Greek, which is gamma. Now gamma is probably the least understood of the Greeks, and delta moves with the price of the stock. Gamma moves with the price of delta. And what that means, gamma measures the rate of change of delta. And again, I know that's kind of hard to wrap your head around if you're not familiar with it, but gamma is basically the speed of delta. And I was trying to think of a good example, and I came up with this. If delta tells you how fast your car is going, for example, the gamma tells you how hard you're pressing the gas. Does that make sense? So you press the gas harder, the car goes faster, so it can accelerate the rate of delta. Or you take your foot off the gas and it reduces the speed of delta, right? And why would that matter? Well, gamma really picks up the closer you get to expiration, so that means that those call options that you buy or sell, or put options you buy or sell, can move a lot more unexpectedly than you think they could, based on the gamma. So in other words, as you get closer and closer to expiration, those things can accelerate much faster for or against you. Now it's good or bad. It depends if you bought or sold the options and which side you're on, that type thing. But it's something that you really need to know. And again, it's probably the least understood of the Greeks. And again, it can really add or take away risk if you're holding options near expiration, because your position can shift dramatically, very quickly, as that gamma increases. The next Greek we have is Theta. I watch them all, but I really keep my eye on Theta a lot. And it depends a lot if you're an option buyer or an option seller. I do a lot of option selling, credit spreads, iron condors, things like that. So I would like to have a high theta, right? So the definition of theta measures time decay, and the time decay is how much that option makes or loses each day. And I always think about this, do you want to get paid a check every day, or do you want to write a check every day? And it depends if you're buying or selling options, right? So let me show you what I mean. On this option, come back to NVIDIA here. Let's just look at a 140. I'm just looking at a call here. You see that says -11. That's 11 cents per day. Doesn't sound like a lot. That's for one contract, times 100, times 200, whatever. However you're doing that can really add up, and that is how much you are losing each day. So if you bought an option for $1, in this scenario, the next day it's worth 89 cents, right? The next day, assuming all things are equal and it doesn't move, right? Does that make sense? So you just have to be aware of it, right? If you're expecting a large move very quickly, this is not as important. If you're not, and I'm talking about from a directional side, if you're long, if you're not sure, then this can add up over time. Now, if I sold this for $1 and the next day it's worth 89 cents, I could buy it back, and that's a profit if you sell it, right? Again, we're going to talk about this a little bit deeper in here, and also if you want to join me in the bias room at Simpler Trading, we do these all the time, and we go over all the Greeks and explain why we're doing. I explain why the thought behind the trade and why we're doing it, and all that kind of stuff, right? But anyway, remember theta is the time decay of each option, and generally speaking, it hurts buyers, but it helps sellers because you're collecting that premium if you're selling. And if you are buying options, which we all like to buy options, right? But you're kind of swimming upstream against the theta. But that will also help you to structure your trades in the correct manner. Maybe you're not buying long calls. Maybe it's more beneficial to do a debit spread or a butterfly or something like that. One last thing on theta. Theta is not linear, meaning it's not 11 cents a day. This will actually, if you bought options, this will actually increase every day. So it's 11 cents today, maybe tomorrow it's 12. A week from now it's 30 cents a day. 2 weeks from now it's 50 cents a day. So it increases, and it increases rapidly the closer you get to expiration. Again, we're going to talk about it here a little bit more in a minute. But first, let's jump into our last of the Greeks, and that is Vega. I really like Vega. All these are important. I don't really have a favorite. I really don't. It's hard to say because I watch them all the time. But Vega measures, think of this, V for volatility. Vega measures how sensitive an option is to changes in volatility. Again, it's a little harder to wrap your head around at first, but once you get this, it really helps you a lot. So think about this. Let's go back to our example here, and let's look at a 140. And as you can see on our Vega, let's go back down here. You see that 17 cents? A Vega of 0.17 or 17 cents means that it's going to gain or lose, that's plus or minus, depending if you bought or sold the option, right? It's going to gain or lose 17 cents per contract if implied volatility rises or falls by 1%. And we know that can happen easily in NVIDIA. In this example, if it was SPX, it would be the volatility of SPX and so forth. Amgen or Amazon or whatever would be the volatility of that. But when volatility goes up or down, it adds or takes away from your trade. So it can be wind at your back, or it can be, you're swimming against the tide going out. And this is, again, keenly important in structuring your trade to, if you're expecting volatility to come down in an instrument, volatility to drop, a vol crush or whatever, then you want to be selling this and collecting this 17 cents. Or if you think volatility is going to go up, maybe you want to buy it. And again, that can go back to the structure of your trade. You want to be buying long calls or puts, or debit spreads or credit spreads, or calendars or diagonals or calendars. And it's not that complicated once you understand the Greeks and how they work together. Now, if you're not that familiar with the Vega and you put on a trade that has a big, volatility component, you can have a vol crush go against you, for example, on earnings. And I'll show you here in just a second, big vol crush around earnings, and your trade, you can be right on direction and you can still lose money. So that's very important to be aware of. I've got a chart here, and this is pretty crude chart, but you can screenshot this or whatever. But as you can see, our delta measures price movement. It affects the direction. Our gamma is the change in the delta, and it affects the acceleration, again, of delta. This chart says most used for short sellers. I think all these are for all traders, honestly. Theta is your time decay. It is your daily value loss or gain. You can have a gain here. Depends if you buy or sell options, because you can be on one side or the other, right? It helps option sellers and it hurts option buyers. Vega is your volatility change. V for volatility. Delta, D for direction, right? And theta, I would say time. Theta, time. Don't really have one for gamma, but back to Vega, it's your price sensitivity to volatility, right? Really can affect earnings trades, and I'll show you that here in just a second. But again, the point is that once you understand the Greeks, it gives you a giant edge versus everybody else. You're either professional trader or amateur trader if you don't use the Greeks. And I know a lot of people think, oh, it's too heavy duty math, I can't understand it. It's pretty straightforward. It's like anything else. Once you get it, you got it, and it can make a dramatic difference in your trading. So let's look at some examples real quick. Okay, first of all, since we finished with Vega, let's jump over here to the chart, and I want to show you an actual example of Vega. Let me clear that. Okay, so check this out. This is on Amazon. We all know Amazon. All love Amazon. These are earnings events. This chart's going back, I think, 2 years. So these are all the earnings events. So what happens, the volatility rises into earnings because nobody knows what's going to happen. Are they going to report good earnings or bad earnings? What's going to happen? Oh no, what's going to happen? Once the news is released, the volatility comes out of the stock, and that is your vol crush. And look at this. Vol rises up, earnings are announced, vol crush. Vol rises up, earnings announced, vol crush. Just like clockwork. So if you knew that was going to happen every time, would you change the way you trade this going into earnings and on the other side of earnings? Of course you would, because you know how the volatility is likely to change. So what you might want to do is maybe we buy options here and we sell options here. Actually sell here. You're buying the option because they're increasing on the way up, which is pumping the price of your options if you're buying calls, for example. Here, if you sold calls, they vol crush and they're instantly worth more money. So this is just one very simple way of explaining how the Vega can really affect your trades. Now let's look at another trade and use all the other Greeks, and I'll show you. Let me grab a trade real quick and we'll look at it. All right, let's stick with our Amazon example, and I will walk through real quick. If you're familiar with TOS, I'm going to use the Analyze tab here because it shows you all the Greeks. Very, very helpful. All right, so Amazon, and let's just do a very simple example or comparison. If you want to buy 100 shares of stock in Amazon, we're just going to buy 100 shares. $211 a share, cost you about $21,000. 211 times 100. So $21,000 to buy it. Notice, what's your delta? 100. You've got 100 shares. Basically, there's no other Greeks for shares of stock, right? Doesn't matter if it's Apple or Nvidia or Google, whatever, it doesn't matter. Anytime you buy 100 shares of stock, you have 100 delta. This is what makes it easy to hedge, because if you needed to cut your deltas down in half, you could do something to take that from 100 to 50 pretty easily with an option strategy like some puts or something. But anyway, so this kind of gives us a baseline, so 100 long delta. So what if we went over here to our trade tab, and let's just go out to July again, and let's go to 220. Let's just buy some calls, because that's, everybody likes buying calls. Oops, that's selling. We're going to buy some calls here, and they're going to be $4.25. And let's compare. So check this out. So right here, we're spending $21,000 to get 100 delta. Now remember that is the directional aspect of the trade. So if Amazon goes up $1 and you're holding 100 shares, if it goes up $1, what do you make? You make $100. All right? You got 100 delta. Right? If you bought the calls, it cost you $4,250. A lot less than 21,000, right? $4.25 times 10 contracts, and this is 1,000 shares. 10 contracts is 1,000 shares, right? Equivalent to 1,000 shares. So we have 361 long delta. So for every dollar Amazon goes up, $1 equals $361 to us in this example, all things being equal, right? That's pretty good. You get a lot more bang for the buck for a lot less cost. Well, that's great. Well, what's the downside? Well, one, it expires. It has to move before that expiration. This you can hold for 20 years. It doesn't matter, right? That's one thing. This negative theta, you are losing $107 a day from your 361 minus 107. This is ballpark kind of stuff. If any math guys out there, you're going to say, well, if you technically do this and this and this, it's not quite that. We're ballparking here, but that's generally how it works. So this theta comes off of any gain. So in other words, it needs to move by $107 a day just to stay even. Now we're expecting in this example, say earnings are coming up, we're expecting a big move. This is way more powerful to do it this way, right? What do we got to look out for? We got a lot of Vega there. So remember what our Vega does. For every $1% in volatility of Amazon, if we get plus 1% higher volatility, that pays us $242 profit. You know, people are like, well, how can you profit from volatility? There you go. That's it, right? So this can help or hurt. What if it drops 1%? Well, you just lost $242. You got to understand this stuff. It's can push and pull on your trade in crazy ways that you don't even know, right? Unless you understand these. So are we getting enough Vega or too much Vega? Are we losing too much theta? That's good if you sell these options, right? Gamma basically adds on to the delta essentially. So that increases the 361 by about 21, which again, if we go higher, this greatly helps us. And if we go lower, it's like a boat anchor dragging behind us, right? So I know I'm going kind of fast, and I want to kind of keep it general. One last thing here. Let's flip these over to puts, and I'm going to drop this down to say, I don't know, 215. So if we sold puts, we're bullish on Amazon. We sold puts, we're making about $90 a day. If we stay here, or actually if we go higher, we make more money. So this is good, right? We have a lot of long delta. This is a bullish trade. You know, you're like, oh, we're on the put side. How's it bullish? We're selling that. We need this thing to go higher, right? But we're sitting there. The stock doesn't do anything. We make $90 a day. Again, we have a big negative Vega component because we're negative here. We sold. We're positive here because we bought. Again, it changes from side to side, whether you're buying or selling. Then it changes from puts to calls. Again, it sounds complicated. It's really not. Just take it baby steps and go one step at a time. And once you get all this understood, it will greatly help your trading results. It'll greatly help your confidence with trading because you know how to structure a trade properly or more efficiently. You know, is it better to use if you want to get long, is it better to use a bullish butterfly or a call debit spread, or just long calls, or long calls going to decay too fast and a butterfly doesn't? You know, that type thing can really help you. So next time, you know, think about using the Greeks, even if it's baby steps. You got to learn it step by step. I am more than happy to help you. Let me know. This is going to be on YouTube, so leave comments down below. I'm happy to answer there. Also, come join me. We'll put a link to my trade service at Simpler Trading. It's called Bias, and we're in there doing these strategies all the time, and we're looking at the Greeks and studying this stuff as we go and learning it. And the more you know, again, your trading results should get better, and your confidence in your trades will increase as well. So with that, let me wind it up here. Of course, you know, like, subscribe. I'm going to be putting out many more of these. We'll go in more detail in future videos. But thanks for your time, guys. I really appreciate it. And come join me in the bias room at Simpler Trading. Thanks. Take care.
Without Simpler Trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency. It's one of the things that won me